part of what makes Vectra special is the fact that it's a local management team. People really have the ability to come in and make a difference.
Our CEO says it best. He says that we have a soul that really captures a lot of who we are.
The culture at Vectra allows individuals to come to work and be creative. The creativity comes with solutions.
At Vectra Bank, we're going to understand the challenges that you face on a day-to-day basis and create solutions to help your business be more profitable and be more efficient.
We're not an 8-to-5 business. We have to be 24/7, and that's what relationship banking is, being there when they need you.
The reason why big enough to count and small enough to care really works for us is that being part of a regional bank, a $70 billion bank, we have access to capital. We're a public company that can move with the markets, but we're managed locally.
We operate like a local community bank, but we have the capacity of a regional powerhouse.
It's good quality people that enjoy coming together on a daily basis, solving problems, solving issues. So that's why we're here. That's what we provide.
Having the opportunity to have meaningful relationships, taking the time to get to know clients and bring them solutions that they hadn't thought of.
We have a responsibility to give back. We have a voice, and we have some capital capacity to help make a difference.
Being able to care about the client and bring them those resources is that big enough to count and small enough to care.
I think soul comes only if you're passionate about what you do, if you care about the people with whom you work, if you care about the customers with whom you work, you can make a difference in anything you touch.
Good morning, everyone. Thank you so much for being here today, and thanks for letting us share a little bit about our vision about Vectra Bank Colorado. We're really excited about our niche in the marketplace and our ability to be passionate about helping Colorado and helping all of you in your businesses. I'm Bruce Alexander. I'm president and CEO of Vectra Bank Colorado, and I'm proud to welcome you today to Vectra Bank's 27th annual economic forecast breakfast. I almost wanted to ask, how many people have you been here for all 27 years? Has anybody been here that long? You probably have, Don, right? Anyway, we're excited about that, and we really appreciate you being here. I want to thank, too, besides all of you for joining us this morning, we have clients and colleagues across the state who are participating in this event and on our live webcast. I'd also like to thank a few people that showed up. We have friends from the Denver Metro Chamber of Commerce, from the Colorado Women's Chamber of Commerce, from the Colorado Bankers Association, and Larry from the Colorado Sun. Thank you all for what you do for our community. We really appreciate that. Today's theme is Hindsight 2020. As we look back on the year that has been, and we look forward on the year and the decade ahead, key trends and market signals to continue to be essential to watch. While we cannot see directly into the future, one thing we can predict is that uncertainty in the markets is here to stay. In 2019, Colorado enjoyed a strong economy across the board. There was growth in almost every sector, unemployment rates remained low, and the stock market continues to hit record highs. However, even with all this good news, much of 2019 was still spent discussing the possibility and timing of the next recession, the vagaries of both state and national politics, the impact of tariffs, natural disasters. Now we have problems with China and new diseases, and conflicts around the world are reinforcing an uncertainty that our economy will be able to sustain its positive momentum. Our speakers today will share their vision for 2020 as well as their review of 2019, and will address the status of the economy at both a state and national level. You will learn where we are in the current business cycle, and you will hear about trends in the core drivers of our economy and what to watch for in the year ahead. At Vectra, we pay close attention to the information and guidance shared by our speakers each year, and like many of you, we use this data to think differently about our business and adjust our plans accordingly. Today, we've left time at the end of the event to give you access to our speakers, and at any time you can submit your questions using the QR code printed on your centerpieces. We'd also appreciate your comments or questions via Twitter at #VectraForecast. To our website participants, you can submit your question right on the Webcast homepage. Here today to introduce our first speaker is our good partner, JJ Ament, CEO of the Denver Metro EDC. Please help me welcome JJ.
Appreciate it. Thank you. Well, good morning. The Metro Denver Economic Development Corporation is proud to be here this morning with our great friends and colleagues from Vectra Bank. The Metro Denver EDC, remember, is the privately funded and privately governed organization, all things economy in the Metro Denver region, including corporate recruitment, attraction, retention, and capital investment. And as part of the Denver Metro Chambers family, working to future-proof Colorado's economy. Now, you're about to hear from Patty Silverstein, our chief economist, on our positive outlook for 2020. So spoiler alert, it is positive. But let me be very candid. The primary risks to our vibrancy in 2020 and 2021 really, in our view, is not about economic cycle or data. The risk can be a complacency that we may have toward public policy and politics. The positive economic forecast you're about to hear is up to you to actually achieve, but it's subject to some real risks. Costly legislative proposals and ballot measures ranging from an artificial limit on housing permits that we'll see this fall to changes in Colorado's income tax code that would frankly make Connecticut and Massachusetts blush. So my pitch to you this morning is to get involved beyond this breakfast, the way that Vectra Bank has by making this investment in the Metro Chamber and the Metro Denver EDC. Because the data that we're talking about, this economy, is more than just numbers on the page or a screen. This is about real people. It represents you. It represents our friends and neighbors and great jobs in a thriving economy that doesn't just happen. It happens because of you and the investments and the risks that you make and take and the contributions that we all have to our community together. So let's not take any of that for granted. The numbers are good, but they don't happen by themselves. We have to stay engaged to keep Colorado's economy strong. So with that breakfast call to action, I'm now proud to introduce who will deliver what we believe will be a robust 2020 economic forecast, the Metro Denver EDC's consulting chief economist and the president of Development Research Partners. Please welcome Patty Silverstein. Thanks, Pat. That would change the economy fast.
Hello, everyone. How you doing? Good. Well, let's talk about the economy, shall we? And let's talk about this whole 2020 vision. Are we seeing things through nice, clear lenses, or are things cloudy out there? And there's a little bit of both, without a doubt, that is happening there. So I know that Ryan is going to talk all about the national, the international levels, but I want to just set the stage a little bit by talking about national GDP and our periods of growth versus contraction at a whole national level. So if you look at this chart, this is GDP then showing the quarterly changes. What we see right now is that we are in the midst of the longest economic expansion in modern U.S. history. We're now at 126 months. The prior longest expansion in U.S. history was that period from 1991 through 2001, which was a period of 120 months, 10 years. And there's going to be a few instances where I'm going to refer to data from that 1990s period of growth and comparing that to today so that we can keep in mind where we're at and potentially where we are headed. We're going to take a look at what's happening in terms of employment and commercial real estate here first, and then we'll start taking a look at what's happening with consumers and residential real estate. So when we take a look at our employment and commercial real estate, right now there are some things that we know we can see very clearly. We are in an environment of stable interest rates. It's hard to find workers. You've heard me talk about this before, and it still is very challenging to find those workers out there. We are seeing wages that are going up and still a very active construction market. But there are some things that are kind of clouding our vision too when we start making our business plans and all. The tariffs, the trade war certainly is having an influence on some of our Colorado businesses. There's this whole geopolitical risk all across the globe, certainly. An uncertain future for oil and gas, which is an important industry here in Colorado. And also, as JJ had kind of alluded to, this whole anti-growth initiative that we all are going to need to be having the conversation about growth. And so I want to raise some of the issues about that. So first of all, to put Colorado's growth in context here, throughout the country, we're seeing growth in 47 of the states. There are 3 states, Wyoming, Oklahoma, and Vermont, that are actually still kind of shedding some jobs there, but everywhere else is seeing growth, and those states that are on the darkest color are those that are experiencing the strongest level of growth. Our neighbor to the west, Utah. Yeah, we keep close tabs on what's happening in Utah because they are very competitive here with us in the Metro Denver region and in Colorado on both the business front as well as the tourism front. They are right now adding jobs at the fastest pace in the U.S. Texas number 2, Idaho number 3, and Colorado we are currently ranked at number 10 in terms of job growth. So our expectation as we look out into 2020 is that, yes, we will continue to add jobs in Colorado and in Metro Denver, but at a slower pace than what we have seen over the last few years. So think back, if maybe you were here, maybe you weren't, but back in 2014, that was kind of the peak period of growth in this cycle for us here in Colorado. During that period of time, Colorado added about 83,000 net new jobs. Metro Denver added about 55,000 net new jobs. The growth rates that we are seeing now are putting that job growth level at about half of that pace. So certainly still growing, still expanding, nice steady pace of growth, albeit, as I say, at a slower pace. And the expectation is that we will still add jobs at a faster pace than what we see happening at a national level. When we look throughout the state of Colorado, so our metropolitan statistical areas, or basically our urbanized areas across the state of Colorado, there are 7 of them, and these 7 MSAs constitute 17 of our 64 counties. So what's happening within these urbanized areas? Well, first thing to note, Boulder. That Boulder County area is expanding at the fastest pace right now. They're seeing job growth related to the high technology industry up there. Software is certainly expanding very rapidly in that region. Google, of course, has been the big headline up in the Boulder area. Greeley, which is Weld County, is also growing at a fast pace. And you will say, well, wait a minute, didn't you just say they have kind of this uncertain oil and gas future? Yes, there are some challenges related to oil and gas, but they're also seeing there in Weld County, they have a strong base of renewable energies with Vestas located up there. So really diversifying that economic base and continuing to see some good, strong growth up there. Then you get to Fort Collins, Colorado Springs, and Grand Junction, all increasing at about the same pace right now. Fort Collins also being driven by high technology. Colorado Springs, to a degree, that as well. They've really become, though, this opportunity for companies that want to grow and expand at a little cheaper rate. They're a little less expensive than perhaps some of our other Front Range areas. And also cybersecurity has been a big industry down there. Grand Junction, yes, yay. They're growing, they're expanding. And a lot of that is also due to retiree attraction there. In Denver, here, the Metro Denver region, we're growing at one of the slower paces. And we'll talk a little bit about our job growth and what's driving that in just a moment. And then just to highlight Pueblo there, that is kind of our urbanized areas, that is the slowest growth area in the state of Colorado right now, still having trouble kind of diversifying from the whole steel industry there. So that's where we're at now. I want to take that step back to the 1990s. So in this map of the state then, the red parts represent hot, blue is cold, and that's going to be the case in a few different maps that I'm going to show you here. So in the 1990s, notice that we added about 680,000 jobs. That was a 3.7% average annual increase in employment. That was huge. I mean, we're now tracking at about a 1.6% pace. And there were 2 counties that lost employment during that whole 10-year period. So that was Lake County and San Juan, and between the 2 of them, they lost less than 100 positions over that period of time. Fast forward now to the current economic conditions, the current growth that we see. And remember again, red is hot, blue is cold. So in this current 10-year period of expansion, we have 23 counties whose employment base is lower today than it had been 10 years ago. Most of the growth that we see happening is indeed happening along Colorado's Front Range. Indeed, 99.2% of the jobs that have been added in this 10-year period have occurred in that region from Larimer and Weld counties all the way down into Pueblo County. So, and to notice too that our employment growth rate is averaging 1.5% right now. That is half the pace of growth that we saw during the 1990s. So yes, let's have the growth discussion. Let's talk about how we manage growth, but certainly let's also keep in mind that one size does not fit all within our state of Colorado, and that there are many parts of our state that are indeed being left behind in this longest economic expansion in U.S. history. So in the Metro Denver region, taking a look at what types of jobs, what type of industries are expanding, this is all based on what is called the North American Industry Classification System codes. All companies that are operating are classified in one of these. These are aggregated up to super sectors. Professional and business services is our largest industry grouping, and that includes everything from accounting and legal to a lot of your software design and also architectural opportunities there as well. Our largest group has also been the one that has added the most jobs and is expected to add the most jobs as we look out into 2020. That's great news because professional and business services are providing those services to all other businesses. So if they are doing well, it generally means that all those other businesses are doing well also. On down to our smallest industry, which is information. That's print media, that's broadcast media. That also includes some of our high-tech sector, where we see some companies, the lines are getting very blurry right about now. Talk about cloudy vision, but where we classify some of those high-technology companies. Are they information providers? Are they software providers? It is getting very, very hard to sometimes classify some of our companies. But that group is our smallest group and has seen some reasonable growth over the past year and is expected to continue into 2020. Notice that the third one from the top there, wholesale and retail trade, is our slowest growing industry. On the other hand, the third from the bottom, transportation, warehousing, and utilities, is our fastest growing industry. I bring both of these up because transportation, yes, it includes air transportation, but that whole warehousing, that's our logistics industry that is really driving the growth of this. That's the Amazon effect. So keep in mind that as we have talked about how we're starting to see some changes as far as where people are spending their dollars, whether they're going to brick and mortar stores, whether they're doing online types of purchases, we're starting to see those shifts and changes coming through in some of our employment data here because we have certainly seen a large increase in logistics and e-commerce companies and their fulfillment centers that are located here in the Metro Denver region. So one of the greatest challenges to our continued expansion in the Metro Denver region and indeed in the state of Colorado is finding workers. If you're out there trying to hire anybody in your companies, you know how challenging that can be right about now. So notice that our labor force participation rate, which is basically the percentage of our population that is either working or actively looking for work there, is kind of reaching a point where we're seeing some real stabilization in that. It used to be that we thought, okay, we can grow the labor force, we can pull people in from the sidelines that for whatever reason we're no longer participating in the employment market. We've kind of tapped that out right about now. So our expectation is that unemployment rate is still going to be very, very low. So key point to all of you that are making hiring decisions, get those good workers. Do everything you possibly can to hang on to those good workers because our expectation is that this labor market is still going to be very, very tight. So One of the good news for those employees out there because of this tight labor market is we're seeing some nice increases in wages finally. That may not be good news if you're the business owner because this may certainly be putting some cost pressures on you there. But right about now, so from the period from June 2018 to June 2019, Colorado had the second fastest increase in wages in the country. We had a 4.9% increase in our average annual wage. Notice that the other states that increased very rapidly were Washington and California, but all states all across the country did indeed see an increase in those average wages. Hitting upon our commercial real estate then, taking a look at office, industrial, and retail, I have on the chart here both our vacancy rate as well as the average lease rate, what is happening over time. In those healthy markets, we like to see that vacancy rate going down, that average lease rate coming up. And certainly we are seeing that on the office side, although we're starting to see then that the rate of decrease in the vacancy rates is slowing, the rate of increase in the lease rates is also slowing. On the industrial side, starting to see a little bit of pop-up in terms of that vacancy rate. On the retail side, we're also seeing that vacancy rate increase a little bit, but on the retail side, we're also seeing that the lease rate is coming down a little bit. Again, kind of mirroring some of the issues that we're seeing in terms of our brick and mortar retail throughout the Metro Denver region. The big story remains construction activity when we talk about the commercial real estate markets. Oh my gosh. 2018 was a peak year in terms of adding office, industrial, and retail throughout the Metro Denver region. We added 11 million square feet. We saw a little bit of pullback in 2019, mainly because we still had a lot of buildings that were under construction, just not being completed, versus now as we move into 2020, the amount of completions will be around 10 million square feet once again. So it remains a very active commercial real estate market. So turning now to consumers, how you and I get out there, spend our dollars, and our influence on the residential real estate markets. Again, a lot of things that we see pretty clearly that are influencing our spending patterns with stable interest rates and rising wages. We have an aging population and a slowing growth in our population as well. But the cloudy side, consumer confidence, we're seeing consumers are getting a little shaky out there. That's a bit of a challenge, and I think that that's going to be something that Ryan is going to talk about in a little more detail as well. The anti-growth initiative, again, how this will influence what we're seeing happening in terms of housing affordability and new home construction. Just to keep in mind from a whole population side, a population growth side, so in this period from 2010 to 2019, Colorado was the third fastest growing state. If we take a look at just the most recent year, from 2018 to 2019, Colorado was the 8th fastest growing state. We are starting to see this whole slowdown in terms of our growth pattern, not just here in Colorado, but indeed all across the country. In the Metro Denver region specifically, our population grows because of two things. We have a natural increase in the population, meaning that our births are greater than deaths, and we see a net migration influence, so a number of people moving in, less the number of people moving out. We're seeing some slower net migration. Again, this is happening all across the country, but certainly happening here as well, with fewer than 10% of Americans changing their residence in that period from 2018 to 2019. This was down from a period of time like in the 1960s where you had about 20% of the people. So definitely we're seeing this whole slowdown in migration activity, and so therefore we are also seeing a slowdown in our population growth. So rather than adding on average around 45,000 people here in Metro Denver, our expectation in 2020 is that we will add less than 38,000 new people in the area. And again, the whole growth discussion, we talked about employment growth, and people generally, when they talk about growth, they're like, oh yeah, we like the jobs, we just don't like the people that come with them. They're related. They are related here. And certainly when we take a look at population growth that is happening, again, in that 1990s period, we had 5 counties that shed people, but growth was pervasive pretty much throughout the state. Fast forward to our most current growth period, then the last 10 years, we see that 20 counties in Colorado have lost people. 13 counties, which are in that light blue, have basically been flat. So 33 of our 64 counties are either losing people or seeing a flat type of population change within their area. But let's also have the discussion that one size does not fit all, and we need to really be tackling the issues of managing growth appropriately. So that was my soapbox. Okay, moving on. Consumers. We've been out there, we've been spending money, but we're also seeing, as I had mentioned, that our confidence levels are not quite what they had been. So back in 2017, our confidence levels were increasing by 26% over the course of that year. In 2019, and our expectation for 2020, in the mountain region, our confidence is increasing by only about 1%. Yes, we are still at very high levels of confidence, but we're starting to become a little more timid here. Remember, this also tends to be related very closely with what we see happening in terms of retail sales activity, retail sales tax, important for our state of Colorado, important for our communities. So again, another big takeaway from today, be happy, people, spend some money, okay? Keep us going. Our consumer activity represents 70% nearly of our overall economic activity. If we are out there and are feeling confident in our actions, chances are the economy is going to do okay as well. All right, the one thing that has been a bit of a challenge, though, certainly has been our home prices in Metro Denver and throughout the state of Colorado. So right now, Boulder, that Boulder MSA, is the 7th most expensive housing market in the country. They see a median home price approaching $630,000. Metro Denver, you've heard me say this before, we're no great bargain ourselves. We are the 11th most expensive. The good news, though, is that we are seeing those home price appreciation rates start to slow. Now, if you're a homeowner, I get it that you're saying, oh, Patty, I don't like that news. But truly, from an affordability perspective, making sure that our workers can indeed afford homes here, move up in homes, this is very good news that we are starting to see those appreciation rates really slow to about 3.5%. And we're starting to see then that we're seeing that our home appreciation rates are better matching our wage rates, the increases that we're seeing here. Remember, wages going up by 4.9% in Colorado, according to the most recent data. Again, our expectation is housing prices will be up by about 3.5%. The reason that we're seeing that more stable increases in all of our apartment lease rates as well as our home rates is that we have finally kind of caught up, if you will, in terms of new construction within our marketplace. There had been a period of time when we were building next to nothing, but we still had a growing population. Now that we have been building a couple of years, we've seen number of new units introduced, over 24,000. Our average is around 17,500 or so. So we have been building more than our average, which is why we're starting to see some of those prices start to stabilize, which again is very good news for our area. So with that, be happy, people, spend money, keep the economy going, okay? Thanks much.
Thank you, Patty. I so appreciate her passion for the economy. Does anybody get more passionate about the economy than she? And I know it's probably heresy for you and JJ, but because our corporate parent is located in Utah, I'm okay that they're doing really well. So anyway, thank you for all you do for us. So another important and vibrant driver of our economic success centers on our partnership between the for-profit, nonprofit, and governmental sectors that help shape our area's growth. It has been a tradition at this event each year to celebrate the success of these community partners by presenting a donation to a local nonprofit organization or foundation. Today, we're pleased to continue that tradition by recognizing an inspiring and successful organization in our community. and one that certainly shares a unique vision across multiple generations. Vaughn's vision. Founded by Von Miller in 2012, Vaughn's vision provides low-income children throughout Denver with access to eye care and with the corrective eyewear they need to be their best in the classroom and in life. As a member of the executive board of directors of Vaughn's Vision, I am both personally involved and exceedingly proud of the more than $5.1 million in vision care and eyewear Vaughn has provided to over 8,500 kids. Just amazing to me. It has been a pleasure to see and support Vaughn's commitment to his foundation and the children they serve. Leveraging his celebrity and his undeniable personality and talent, Vaughn's passion for supporting these children is genuine and directly linked to his own personal experience. We are honored to recognize his efforts with a $5,000 contribution today. While Vaughn's out of town, can you believe he went to the Pro Bowl instead of coming to our event today? We are pleased to welcome Lisa McAllister and Laura Gill, who are joining us as representatives of Vaughn's Vision. Would you please stand, ladies, and let us recognize you for your support? Thank you, and next time we'll have Vaughn here, right? Okay, thank you so much. Now, I'm really excited to present our keynote speaker, Ryan Dietrich. Ryan is regularly sought after by the national media, including CNBC, Bloomberg, and others. Ryan is a senior market strategist for LPL Financial, and LPL is our wealth management partner in Colorado, providing financial advice to so many of you in the room. In this role, Ryan is a frequent presenter to clients, industry peers, and the national media on emerging and developing market trends. Some of you may remember a couple of years ago, LPL presented to us. In 2018, LPL predicted a return to an environment in which investors would be rewarded for their ability to focus on business fundamentals, including an evolution of the economy that would involve a combination of infrastructure spending, tax reform, and regulatory relief. Since that time, we have seen historic changes in tax reform. Regulatory relief has come in stages. Don likes that, right, Don? And the Federal Reserve continues to monitor interest rates closely to help guide and encourage economic spending and growth. It has certainly been a unique couple of years in our economy, and I'm really looking forward to learning more about Ryan's vision for 2020 today. Please help me welcome to the podium Ryan Dietrich.
Thanks, Bruce.
So much for being here.
Hi, everybody. All right, let's see. There's my mic on? There we go. So Von Miller, I was actually in Colorado, I think it was in late June for an event up in the mountains, and I presented, and after me was Carl Mecklenburg. Now, let me tell you, nobody wanted to see me. They were all there for Carl Mecklenburg, so that's okay. So, good morning. Thank you for having me. I'm honored to be here. Ryan Dietrich, Senior Market Strategist with LPL. I flew in from Charlotte yesterday, and my flight home is at noon today. So I'm here and looking forward to discussing markets and having a lot of fun. So, kind of building on a couple themes that Patty just mentioned. At LPL, we've been bullish on the economy. We've been bullish on the stock market for the 4 years that I've been there, and we still are in that camp. Now, let's put things in perspective. This is a 10.5-year cycle of growth for the U.S. economy, as Patty said, an all-time record. But if you look at nominal GDP, we've created about 50% nominal GDP this cycle. The previous 10 cycles, back to World War II, averaged 50%, actually 49, but close enough. So the question is this the longest cycle of growth ever? Yes. Maybe is it just an average cycle of growth, suggesting growing at 2.5%, like we continue to see, this cycle can continue to go. Anyone in the room know the last time Australia had a recession? I'll yell it out. Patty knows probably. When was it? 28 years ago. The last time, so if you look all over Europe, you look all over Asia, 15 and 16-year cycles of developed countries without a recession. We're pushing 11 here in the United States. We used to have recessions every couple of years if you go back in history, back to the 1850s. We're more of a developed country now. So again, just because it's a long economic cycle, and I'm going to share a lot of charts and go through some more things, that doesn't mean you just have to fall into a recession right away. Lastly, it's an election year, as we all know. And we just did some research on this because it's one of the most popular questions we've had from our advisors really the last couple of weeks. Okay, this is year 4 of the election cycle. What does that mean? Well, we have a president up for re-election. We took a look. You have to go back to 1940, the last time the stock market was down when a president was up for a re-election, FDR. We all remember 2000, 2008. Those are lame duck presidents. It's never this simple. But just think about it. Why? It's not about Republican. It's not about Democrat. It's about getting reelected. Also, we've never had a recession during the 4th year of a presidential cycle when the president's up for re-election, going back to the Great Depression. So these are just some key notes that we kind of always have in the back of our head that suggest, again, this bull market's old, but it hopefully has a little more life to them. Now, there's lots of positives we've seen out there. One of the positives that I think has just recently been taking over, millennials are really starting to kind of go out and branch out and grow. Some of them are even leaving their parents' house. In fact, I got a kind of behind-the-scenes pic right here of some millennials that took their $30 million, they left mom and dad's house and they flew the coop, and they're going to start growing and helping the global economy. Now, it's obviously a little joke, but one thing that we've learned from Megxit, right? We call it Megxit. One thing we've learned from Megxit, it's not about if you're a prince, you're a queen. It's not about what color you are, religion you are, rich, poor. None of that matters as much as what we learned here. When the holiday season is over, there's nothing you want more than to divorce your family. So 2020, we made it. Let's take a look back. In 2018, okay, the United States stock market, looking at the S&P, was up a record 9 years in a row. GDP grew at 3%. Some of those things that we talked about when Burt White was here and John Lynch were here, discussing why the economy could keep going. Well, 2018, we had 3% GDP growth, the first time since 2006. Best economy we'd seen in 13 years. Earnings up 23% on the S&P, yet the stock market was down. 2019, the economy has clearly slowed down, yet stocks gained over 30%. We're going to kind of talk about what happened there. But we think if you look at 2018 specifically, a big event. Remember the 4th quarter, the big 20% correction, the bear market that we saw? Technically, it wasn't a bear market, down 19.5%, but it sure felt like one, right? On October 3rd, Vice President Pence gave a very aggressive toned speech toward China. This is, again, October 3rd, 2018. October 4th, Fed Chairman Powell said, long way from neutral. All you got to know, that meant we're going to hike rates more than you guys think. Those two events, an aggressive tone toward China, and really what we know now is probably one rate hike too many from the Fed at the end of 2018, caused that massive problem in the 4th quarter of 2018. The Fed, obviously, in 2019 changed. They've done multiple cuts. We'll talk about what that means. And look where we are with China. We just signed phase 1 of the trade deal a week ago. Now, 2018 was very unique. Stocks and bonds were both down. That's the first time since 1969 stocks and bonds are both down in 2018. When you got your statements in the first couple of weeks of 2019, you probably weren't too happy. Gold was down, oil was down, stocks were down, bond was down. You got to go back to the Great Depression the last time we saw a year like that. Good news, 2019, what happened? Our friends at Ned Davis take a look at 8 different asset classes: stocks, small caps, EFA, that's international, emerging markets, bonds, gold, oil. All 8 were up at least 5%. So we saw nothing work in 2018. Fortunately, a lot of things worked in 2019. And as we called our outlook, bringing markets into focus, we look at 2020 and, things that we like to look at. Okay, the S&P was just up 30% for the year. What does that mean? Well, you look back in history, 10 out of 12 times that's happened, the next year was higher, up 15% on average. A big move in the stock market. You usually don't see another big move like that, but continued gains are actually normal. And when can stocks predict the economy? You could talk to 10 people, get 10 answers. I think there could be something there. Stocks do tend to lead the economy. When you have a 20% gain on the S&P 500 going back to World War II, it's happened 26 times. We fell into recession only twice. So 24 of those years, you had good stock market gains. The economy continued to expand. And we really think the good gains that we had last year in the stock market, a lot of that was forward-looking. What we're finding out now is the trade deal with China was probably agreed to in a private room in the middle of October, and then in December it was very clear, and we just signed it. So a lot of those big gains in the fourth quarter of last year were kind of forward-looking and probably going to take away from the gains we potentially could see in 2020. But just bigger picture, there's a much better backdrop, we think, than really what we've seen before. So Murphy's Law, nothing is as easy as it looks. Everything takes longer than you expect, and here's what we all remember. And if anything can go wrong, it will at the worst possible moment. I think to the fourth quarter again. Remember the fourth quarter of 2018, The government was shut down. The Fed did one more rate hike on December 18th. Market collapsed. We had that 4% drop on Christmas Eve. Just vicious, vicious sell-off. Everything that could go wrong did go wrong. Now, one of the cool parts about my job is I get to travel the country. I'm in New York for a couple days next week, Columbus, Ohio after that. I ate at Elway's last night. Anybody ever been there? Yeah, that was neat to get to get some good food when I check out new cities. They get to read a lot on these plane rides, and one of the things that we all know Murphy's Law. One that I read about that I'd never heard of, I found interesting, was something called Cole's Law. Anyone in the room ever heard of Cole's Law? Anyone's ever heard of Cole's Law? There we go. Yeah, see? All right, so I kind of hinted at this. This is what the S&P does after a 30% gain, and the bottom line is 10 out of 12 times the next year's higher, 15% on average. So when you're worried about, okay, the stock market's doing so well, actually let's take a bigger look at things. So the S&P's up a lot. Small caps in the United States are not even at all-time highs right now. The NYSE composite, which is a composite of 1,900 stocks, 1,500 US, 400 global, just broke out the new highs about 3 weeks ago, okay? You look at financial stocks, they're where they were in 2007. A lot of them aren't even above where they were in 2007. Emerging markets, which I'm going to talk about, we like emerging markets. They had a really rough day yesterday with the news out of China with the virus that's spreading. Nonetheless, we like emerging markets. Emerging markets are nowhere near all-time highs. You look all over Europe, a lot of countries still on all-time highs from 21 years ago, okay? So yes, the U.S. has done great. One of our big themes in 2020 this year is maybe the U.S. will pull back a little bit and some of these other parts of the world can do well, specifically emerging markets are where we're tilting a lot of our portfolios. Yogi Bear, it's tough to make predictions, especially about the future, but we're going to try it anyway. So this year, in the U.S., first off, we released our 2020 outlook the first week of November. One of the key things I want to discuss is we didn't anticipate the deal with China being done this quickly. One of the big problems with what's going on with the economy, the consumer is the all-star. The consumer, I see some of the recent data, consumer makes up 72% of GDP. That's probably a little too much because business investment's really one of the key things that are going to keep this cycle going. For the last 2 quarters, it's detracted from GDP, okay? Business investment stopped. Why is that? Because of the uncertainty over trade, more likely than not. So when we released this, we said, 1.8% GDP. You can see globally, we think the U.S. or the global economy is still 3.5%, nearly, almost 5% GDP in emerging markets. And here's the one that people always get at. Yields we think will go a little higher. I'll talk about yields when we get there. But the fair value in the S&P is about 3,200. I mean, that's where we are right now. Now we're talking internally, potentially upping our forecast. This is one of the problems with forecasts. How we're managing the money that we run, the billions of dollars that we run. We are not taking off risk here. We still think this bull market's alive and well. It's just we didn't anticipate in November when we came up with these things kind of how quickly we would find a resolution with China. And you look at some of the recent data that we've been seeing. Some of the global leading economic indicators, keeping this real simple, went down for 17 straight months, just had 2 months ticking higher. CEO confidence all of a sudden is starting to tick higher after dropping. Consumer confidence is high-ish, starting to waver a little, but CEO confidence has been low, and we think it's connected to the uncertainty over trade. But those are some positives that now we have more clarity on trade, which I'll talk about. Those are bigger drivers to help keep this economic cycle going. Socrates, I know one thing and I know nothing, but what did we know in November of 2018? We had a midterm election. We knew we had a Republican president. Well, we knew after that happened, we had a split Congress, right? Senate to the Republicans, House to the Democrats. What this chart shows you is under the scenario of a Republican president, the best scenario for stocks, which is on the left there, that's the S&P 500 in black. Stocks do best when you have a split Congress. GDP's on the other side, they're on the right. The best GDP takes place when you have a split Congress. So it's almost like the four founders wanted it, not too much power for one party or the other. You could joke the best Washington's one, they can't get anything done because they can't seem to agree on anything. But the bottom line, and we noted this in late 2018, why we didn't see a recession in 2019, and this is still in play, right? I mean, the fiscal policies that we put in play, and I think that's coming up here, but economic policy. This is trade. You can see on the chart, whenever we've had, which actually the Trump aggressive speech toward China, Davos, exactly 2 years ago, kind of marked that major peak. And I've seen some talk about how now is like January 2018. We're not totally buying that. I mean, there are clearly differences. Believe me, the S&P's had a great run. There's no question about it. But January of 2018, the S&P was up an all-time record 15 straight months in a row. Then the United States started the trade war with China by putting tariffs on washing machines. The stock market went nowhere for 18 months in essence, and now we're kind of breaking out again. But as you can see, every time trade talks kind of turned tough or kind of fell apart, that led to sell-offs over the last couple of years. What's the trade dispute really all about? Again, it's a good thing we had phase one, or a real good thing we have phase one sealed, signed, sealed, and delivered this week. But this is tariffs that countries pay. You can see China in red, they're about 10%, or I'm sorry, not they pay, but the average tariff that they have is about 10%. The argument the United States has is China is more of a developed country now. Their GDP just came in earlier this week at 6.1%. All you gotta know, that's the lowest they've had in 30 years. I mean, 6% GDP is good, but still they are slowing, so they're becoming more of a developed country. And we think a lot of this, yes, intellectual property, the way China, the military acts, the way they treat their citizens, with Hong Kong, all these things, but a lot of it has to do with the tariffs. And South Korea, as you can see, is on the right. And these are 2017 numbers, because that's the last full year before the trade dispute started. South Korea has drastically lowered some of their tariffs. So these are some positive things that we see. These covers, lies, 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 hey, China, stop stealing our stuff, those are from 5 and 7 years ago. I mean, this is really nothing new, the trade stuff with China. Yes, it caught a lot of people off guard in 2018. It was a big reason why we had good GDP and good earnings growth. The stock market was likely down, but it was also up 9 years in a row. But this is just putting in perspective. This has been around for a while now. Mark Twain said, history doesn't repeat, but it rhymes. In 1995, U.S. and Japan stumbled toward a trade war, the date of the summertime of 1995. What happened in 1994? The Fed was hiking interest rates. The economy was really good. The stock market was flat. 95, the Fed did a surprise pivot. They started to cut interest rates in 95. Economy nowhere near as strong in 95 as it was in 94. And the United States had a big trade war with their largest Asian currency, or the largest Asian partner at the time. Stocks had one of their best years ever in 95. That's a lot like what we're seeing now, where the stock market didn't do much in 2018, economy was good. Fed was hiking rates, 9 interest rate hikes leading up to the last hike in late 2018. Fed did the pivot, 3 interest rate cuts last year, and stock market did well. And what happened in the late 90s, we know, 96, 97, 98, 99, the economy kept going, stock market did tremendous. We're not predicting some type of a major boom like that, but we do think, you look back in history, there's some major similarities, and this economic cycle indeed can continue to go. I love Warren Buffett quotes. This is probably one of my favorite. I checked the actuarial tables, and the lowest death rate is among 6-year-olds. So I decided to eat like a 6-year-old. Kind of like Warren Buffett. So that brings me to eating pizza. Anyone in the room like pizza? Hope so. If I told you guys for $20, I need hands, just a little participation, just your hand. For $20, you want the best deal. Who in the room would buy $20 for the large? Or who would think there's more, bang for your buck, or $20 on the 2 mediums? So by a show of hands, who would buy the large for $20? Couple hands. So the 2 mediums, should be a lot more hands, I hope. Yep, a lot more hands. Look at this. You look at the circumference, there's actually more to the large. Now, for what it's worth, I got this wrong too. I like using things when, that's kind of neat. It's an optical illusion. You see 2 versus 1, you think you squish it together, but nonetheless, what we know when you use math and just try to take a step back is the large is worth more. And that kind of brings us to fiscal policy. What do we know? There was a major tax reform in late 2017. Also, deregulation took place all across financial services. The infrastructure spending plan hadn't even really started yet, but that's still potentially out there. Repatriation is another big thing that took place. That's just simply bringing money from overseas, putting it to work, in theory, in the United States. One of the big things we've heard for a long time is 2018, the stock market was down because it was a sugar high. All the benefits from those reforms and tax reform and different things took place in 2018. It was a sugar high. What this shows you is actually a percent of fiscal stimulus of GDP. 2019, way more fiscal stimulus in 2019 than there was in 2018. And then look at 2020. There's still more fiscal stimulus as a percent of GDP this year than there was in the sugar high year of 2018. These, again, are potential positive tailwinds, we think, to keep this economic cycle going, are things that we would not want to ignore. And again, are things that suggest to us there's likely not a recession in 2020. The Fed. So not all rate cuts are created the same. So the Fed did 9 interest rate hikes starting, December of 15 until December of 18. Then they reversed policy and they did 3 rate cuts last year. Something we heard a lot about was when the Fed started cutting rates in 2001 and 2008, and you can see those are the two, or actually 2001 and 2007. That's the S&P 500 return 6 months and a year later on the right. It's negative. We heard a lot about, the last time the Fed cut rates, we went into great, tech stocks were down 90% in the 2000s, financial stocks were down 90%, my stock market got cut in half. But what they don't tell you is you look back in history, and let's see here, 84, 87, 89, 95, and 98, the stock market did pretty good after a cycle of cutting. The other thing that they don't always tell you, I'm from Cincinnati, Ohio, it ain't bragging if you're telling the truth. Pete Rose, I like that one. Here's the truth. The Fed cut rates 17 times since 1980 when the S&P was at an all-time high, within 2% of all-time high. This is data before the cuts they did last year. 1 year later, the S&P 500 was higher, 17 times, up about 14% on average. So if you have a strong, and believe me, there's people that argue the stock market's so strong, why in the world is the Fed cutting? I'm not going to get into that, but the bottom line is we have what looks like a strong market, an improving global economy, and now we have the 3 25 basis point cuts, and that's the key thing. What did the Fed do when they cut rates last year? They cut 25 basis points. The way they started, let's see if I can go back. The way they started in 2001 and 2007 there, those ones that are negative, they started with a 50 basis point cut. We went back and read the transcripts. The Fed's going to say the same thing. This is a slowdown. This should help. But what they did was a 50 basis point cut, saying they were much more worried. Now they did 325, 3 consecutive 25 cuts. And check out this. That happened 3 other times, in 75, 96, and 98. A year later, after the third cut, the S&P was higher every time, up 20% on average. Now, that doesn't mean you're going to be up 20% on average, but again, these are just tailwinds, little clues to us that say, hey, the Fed is there. Now, what's the Fed up to this year? We think they're on pause. I mean, we think there's likely not going to, it is an election year. Could they hike rates in an election year? Maybe. But the Fed's on record as saying we're not going to do anything until there's more inflation. Now, we're starting to see little trickets of inflation coming in, but overall, we're not as worried about inflation yet, and the Fed doesn't appear to be either, so we don't think there's going to be any, the Fed will do anything this year. They're likely just on hold, especially given it's an election year. But the truth, as Pete Rose would say, is 3 cuts of 25 basis points, normally a bullish thing, and normally it's what they call mid-cycle, and you can have time. Shameless plug here. Am I listening to podcasts? I always joke about, like, if there's bubbles, the fact I have a podcast now, podcast might be in a bubble. But nonetheless, LPL Research was the first broker-dealer to release a podcast. For those who don't know, a podcast is simply on your phone. You can download Google Play or iTunes. You can listen to people talking about anything. And John Lynch, that's my boss. He was here 2 years ago. John and I do a podcast. It comes out every Monday. If you like some of the things, general themes and ideas we're talking about, we're really proud of that. Actually, we are at 149,000 downloads. So that's people that have listened to it. So hopefully in the next week or so, we'll hit 150,000 downloads. But we were the first broker-dealer to have a podcast, LPL was. Now others do it now, but again, I hope it just kind of shows the way LPL looks at the world. It's the Wayne Gretzky quote, right? Skate to where the puck's going to be, not to where the puck is. I don't care what industry you're in. If you can't communicate and you can't connect to people, it doesn't matter. And doing things like podcasts and social media and video versus 2,000-page white papers like we used to write in the research department, that's not what people want to see anymore. So this is a neat example of it, and our podcast, we're proud of it. If you listen to it, let me know what you think. I'd be honored. So let's talk about the economy now. The consumer is a shining star, kind of like Patty just discussed. And what this shows you here, this is quarterly GDP. It might be kind of hard to see, but the yellow on the 2 on the right, that's business spending. It detracted. Business spending detracted from GDP 2 consecutive quarters for the first time since financial crisis. The big blue part, the 2 on the right, the big blue part, that's the consumer spending. I mean, the consumer is incredibly healthy. And one of the questions I get is, look at all the debt. We have a record number of debt in our country, and I totally agree. If you just blindly look at the number of debt, it's called denominator blindness. If you look at overall net wealth relative to debt, we're near the lowest levels we've been since the early 80s. I mean, so again, the big numbers there, but wealth has been going up. Clearly, the stock market's been going up, a big part of it. So it just is a different way to look at it. And again, the consumer's in really good shape in our view. I mean, the recent retail sales numbers that we saw just a week ago, up almost 6% year over year. And that's because December 18, the stock market crashed. People might have held back a little bit on buying that big excursion. But the consumer still looks really healthy, and that's a great thing that we think can keep this cycle going. We need business investment, business spending to come back. And now that we have more of a trade agreement with China, we think that's potentially going to take place, and that can just another reason to extend this business cycle. You hear all the time manufacturing's weak, and it absolutely is. I mean, we're seeing some of the lowest numbers in 10, 12 years in the United States when you look at manufacturing. What this is the last 1, 2, 3, 4, 5 cycles after manufacturing peaked in the United States. A recession started 48 months later. Manufacturing peaked in the United States August of last year, August of 2018, August of 2019, okay? So, we're not even at a year, okay? So it's this big question of there still can be time. What's the stock market do? After manufacturing peaks, goes up for another 50%, well, actually 56% on average. So manufacturing makes up about 12% of GDP right now. It was 45% back in World War II. We are definitely more of a services-based economy, a consumer-based economy. We're not minimizing manufacturing. When you look at a lot of the manufacturing data in the United States, all of a sudden the last 2 months and globally, went down for about a year and a half, starting to bottom, stopped going down. So those are positive things. And again, just because manufacturing's been weak, you can go years without a recession and the stock market can do well. Not everything is what it seems. Here's someone on an island screaming boat, 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 but look at this. The guy on the boat. Land, land, land. It's all about your perspective. It's all about where we're sitting and how we see things. And how we see things at LPL Research, we don't see a recession. I've already laid that out there. But look at this. Emerging markets is the thing I want you to focus on in GDP. There's expected to be more GDP in emerging markets this year, 2020, than there was in 2019. The rest of the globe is going to slow a little bit. And this is one reason we like emerging markets. You look at India, 1.2 billion people, only 1 out of every 4 have a smartphone. Like 4 out of every 5 Americans have a smartphone. You talk about potential. Emerging markets are always about potential. You look at everyone under the age of 30 in the world, 90% of them live in an emerging market. I mean, it is what it is. There's a lot of potential there. And when we look at earnings, I think I've got a chart come up with earnings growth, but nonetheless, I'll say it now. Earnings growth in emerging markets are expected to be about 14%, double what we're seeing in the United States. Valuations are very cheap in emerging markets. It all comes down to if you see a global recession or you don't. If you don't see a global recession, emerging markets very well could do well. And the U.S. dollar, haven't talked too much about that. U.S. dollar, our overall base play, the dollar goes gently lower. Fed's on pause. A lot of people are bullish the dollar. There can be a contrarian play there. So dollar goes lower. That's a tailwind for emerging market economies and emerging market stock markets. And again, the money that we run, we are tilting a little bit towards emerging markets. The big question I get for 4 years at LPL, when are you going to go into developed international, specifically Europe? One of the reasons we've been as a strategist on our platform, we've got 8 other strategists, JP Morgan, BlackRock, companies you've heard of. We're the top performing strategists because we haven't been overweight developed international. We are actively talking about maybe finally dipping our toe in. As of now, we're not, and we like emerging markets the most, we like the U.S. second, and then developed international down there. But still, it's all about relative to the size, right? Our average portfolio has about 6% emerging markets versus 40% U.S. But in terms of who we think could be up the most by the end of this year, we really do think emerging markets are a nice place to find some alpha, some outperformance. Good. We're going to talk about bonds, fixed income for a little bit now. It's not me that can't keep a secret. It's the people who I tell who can't. Abraham Lincoln. I assume Abraham Lincoln said that. It's like Abraham Lincoln, Mark Twain. Those guys get all the quotes. I'm assuming they're theirs. But here's the secret, the yield curve. And I don't want to get too detailed here, but you probably heard last year about the yield curve, which simply looks at different yields across the curve, short end versus long end. Normally, a longer-term yield is going to yield a little bit more than a shorter-term yield. You're going to hold something longer, you should get more for it. That's the best way to put it. When the yield curve flips or inverts, That's led to 9 of the last 9 recessions. It's telling us something is wrong. The bond market is saying we are worried about something. Well, for about the time it took to drink a coffee in late August, the 2-year versus 10-year yield curve did invert here in the United States. The shorter end of the curve inverted earlier. Well, this is something John and I have talked a lot about on the podcast. And John has said, you look globally, our 10-year yield about a year ago was up, 2.5, 275, and had a massive drop lower. But the rest of the globe yields are so low. So is it a function of just massive, massive demand? And when we see record earnings in the U.S., a consumer that's still strong, we're not seeing the hallmark signs of a recession. But the yield curve is definitely flashing some warning signs. But here, let's say when the 2-10 inverted, and by the way, I didn't mention this, they're talking about interest rates or the fixed income. I've said this, I think one of the biggest surprises about last year was not the fact the S&P gained 31%, it was the massive move lower in yields globally. A year ago, Bloomberg had a survey, 61 out of 62 economists said one thing, the 10-year yield would be higher by the end of June, the first half of the year. LPL Research was in that camp too. When everyone's on one side of the boat, that's when you get opportunity to everyone to be wrong and the masses to be wrong and have opportunity. And that's what happened last year when yields went lower. The good news, though, with the move lower in yields, that did help fixed income. Fixed income, if you look at the Barclays Ag, which simply is kind of your average bond fund, 6-year duration, it was the best year for bonds since 2002 because we had those yields move lower. Best year for the stock market since 2013, one of the best years ever. If you had a 60-40 portfolio, 60% of the S&P 500, 40% in treasuries, 60-40, mix it up. You had the best year for your portfolio since 1997, okay? Now, remember, I talked about how 2018 was a really rough year, so we're kind of evening things up. But those are just things to be aware of. But back to the yield curve. The yield curve did invert. I deal with media all the time. I go on TV, I talk to media, and I can tell you the yield curve is something they love to talk about. But here's the truth, and here's, like Abraham Lincoln would say, this is what you need to know. Here's the last, let's see here, 1, 2, 3, 4, 5 times the 2-10 inverted, and you just keep it real simple. After the 2-10 inverted, remember, it inverted this August. Let's say that started the clock. You had a median of 19 months of higher S&P 500 returns before the ultimate peak, a gain of 22% on average. In the late 90s, the S&P gained 40% after the yield curve inverted. So these are things that we're watching, but it's the narrative that is out there, and we want to point out the fact that, yes, we're watching it. We're concerned by what the yield curve is telling us, what the bond market's saying. The other parts of the bond market I'll talk about later that aren't worried about a recession at all, which makes us think this is a function of a balance sheet that went from $1 trillion to $4.5 trillion, started to lower it a little bit. ZIRP, there's zero interest rate policy in different parts, Austria, different parts of Germany, Japan. Some of those countries are realizing I think that's not really working and they're moving away from it. Nonetheless, the bottom line is an inverted yield curve could suggest we're late in the cycle, but that doesn't mean you have to go into a recession and sell all your equities. In fact, that's absolutely what we don't think. This is the negative debt globally. It hit 17 trillion back in the summer. We have, I remember I mentioned how everyone expected higher yields at the start of the year last year. I think August was the exact opposite. Everyone was expecting lower yields. We do something called LPL Focus. It's our big event once a year. It was in San Diego this past summer. And I've never seen so many people so confident that our 10-year yield had only one way to go, and that was lower. The questions we would get was, when is the U.S. 10-year yield going to go lower? We wrote about it in one of our weekly market commentaries, which come out every Monday. You can all Google that and find it pretty quickly, LPL Weekly Market Commentaries. But we wrote about it. We said we don't anticipate a negative yield in the United States. We think yields are going to bottom, the global economy is going to do a little better, and yields can go higher. That's exactly what happened. So everyone was on one side of the boat last August. I think last August was a major, major low. Everyone knew 17 trillion globally debt was negative. Now it's about 11 trillion, recent numbers. So again, it's all about the masses, what the masses are thinking. And still, I think this is why the upside, to me, is yields going a little bit higher than most people anticipate. We said 2.25. Where could LPL be wrong? I think maybe yields can go even a little bit higher than that. You look at what's happening with copper. Copper's been doing really well globally. Emerging markets doing well. Those are things you tend to see when yields start to go higher. So those are just things to be aware of. This is just a chart of the 10-year yield. The 10-year yield bottomed around 150 in the summertime. It bottomed right at that same area in 2012, and then it bottomed right at that same area in Brexit in 2016. So right up from just purely looking at a chart, the 10-year bottomed right about where you'd expect, with everyone saying it had only one way to go, which is lower. Now it's started to go higher, and we think that can continue. Still want to diversify. Peter Bernstein, diversification is the only rational deployment of our ignorance. I mentioned how bonds, we didn't really like bonds all that much this time a year ago, yet yields went lower and a lot of bonds had some really, really good years. And we still think you should be diversified. The area we did like, investment grade corporate bonds, we still like that area. Mortgage-backed securities is probably one of our favorite groups when you're looking for a little bit more yield. And let's be honest, if yields go higher, things like mortgage backs, things like bank loans, high yield bonds, those will do a little bit better. What we're doing in the models that we run for our LPO advisors and their clients, we're shortening up duration, meaning buying a little shorter time bonds, buying a little higher quality later in the cycle is kind of how we're shifting our fixed income models. But if yields go higher, mortgage backs are that one group that we think can really probably benefit the most. And high yield is kind of like stocks really. So if stocks keep doing well, that's a group we like as well. Stay connected. We're on LinkedIn. We're on Twitter. LPLresearch.com is our blog. Lots of really, I think, kind of cool things that we write about and talk about on there. So let's talk about stocks. I've got about 13 minutes, so we should be just good. Planning is everything. Just the fact that you're here means you're planning. The fact you're at Vectra Bank means you're planning. You're in very, very good hands. If you don't plan, this happens. That's why we all need to plan. Earnings still matter. We're in the heart of earnings season. I didn't have a chance. I saw futures bounce today. So we had that, let's talk about yesterday for a second. Had a pretty decent sized drop. Guys, the S&P hasn't been down 1% or more for 3 months, okay? The S&P's been up 4 months in a row. It's up, 2.5% in January, I think. So we might be up 5 months in a row. It's going to sell off. There's going to be a pullback. You look at markets. Trees don't grow forever. Bull markets don't grow forever. We think there's going to be a pullback. And yesterday, could it be the start of the concerns over the virus in China? What's it called? What's the beer? Corona. Yeah, the beer Corona. Coronavirus. I think it's too bad like Corona. That's terrible. They name it Corona. But anyway, the coronavirus. Everyone thinks back to SARS. We're trying to find what happened before. And SARS in 2003, 2004, it definitely took off. Emerging markets didn't do as well. Chinese markets didn't do as well. The Chinese economies didn't do as well when SARS hit. So could this go there? No one knows. But we did see a big sell-off in emerging markets yesterday. But a pretty decent-sized bounce back last night, I guess. But we're monitoring that. But what's the news talking about right now besides that? And actually impeachment. I'm not really going to talk too much about the impeachment stuff. I will say this. We look back in history. When President Clinton was impeached in 1998, the S&P went up 40% those next 6 months. Okay? Now it's not because he was impeached, obviously, but it's about how the economy is doing. The economy can take these things in stride. In 73, 74, when Nixon was going to be impeached, he dropped out of president. He was no longer president because he saw the writing on the wall. But the economy was in one of the worst bear markets, or the economy is in one of the worst recessions we'd seen since the Great Depression when that was taking place. If the economy is strong, that can really take care of a lot of problems. You talk about Iran for a second. So everything going on with Iran. We took a look at the 20 the most recent 20 major geopolitical events that took place going back to World War II for the United States. What's the S&P do? Back to Pearl Harbor. The S&P drops about 5% on average for 3 weeks. Within 2.5 months later, you're back at new highs. The times that had really big sell-offs, those, 9/11, for instance. Well, that was also we were going into a recession. After Pearl Harbor, we were going into a recession. So there's different things about it, but if the economy is holding up, these Middle Eastern skirmishes, we're not ignoring them. They're very significant, but a stock market has a funny way of ignoring them. 2013 was one of the best years we've ever seen in most of our lifetime for stocks. In early June, we were going to our war with Iran. You can go back and look at it. there was major concern about that. And then that shook off, and then the market obviously did well the second half of 2013. But right now, let's talk about earnings. I get on tangents, but let's talk about earnings. So for this year, last year, 2020, we're looking at zero earnings, flat earnings, okay? We did gain 23% the year before, so you average those two out, it's okay. This year, what we see, though, we had a global slowdown last year. There's no question. And it's probably because of, as I talked about, business investment. Companies were scared. CEOs were scared, all about China. Now that's obviously kind of not more of a tailwind with the trade deal being signed. So we think earnings can grow about 6 to 7% in the U.S. We think in the emerging markets can double that, though. So that's good. But this is, again, earnings are expected to pick up. You could say, well, don't you guys always say earnings are going to pick up? And there's some truth to that. But again, it's very, very rare to have zero earnings growth 2 years in a row without a recession. I've already laid out why we don't see a recession. So that's anything's possible, right? But that's why we think earnings can start to pick up a little bit. And honestly, if the U.S. dollar falls a little bit, that can be more of a tailwind for those multinationals, and that can be a little bit of a juice for earnings. This is globally. Emerging, what you got to know is on the right where it says 2020, that the biggest one, I guess that's a dark blue we'll call it, that's emerging markets. The biggest earnings we're going to see this year, a lot of likelihood are going to see this year, will come from emerging markets. But also, it wasn't that long ago, 2014, 2015, we had a global earnings recession. U.S. earnings were down either 5 or 6 quarters in a row, depending on your source, all over Europe, all over Asia, negative earnings for over a year. And the stock markets kind of went Asian markets pulled back more. U.S. stock markets went sideways for about a year and a half. But now we're seeing expanding earnings globally. You talk about, participation. Last year, we follow 93 stock markets. Last year, 92 of them were higher. Only Malaysia was lower last year. And it's because we think the stock markets are more forward-looking. They're aware the global economy, in all likelihood, is going to continue to improve in 2020. And earnings are clearly going to be a big part of that. Don't fight the calendar, and I talked about this. There's, on the blue, your 4-year presidential cycle. Year 3 of the presidential cycle, pre-election year, historically is the best for stocks. Exactly what played out last year with 30% gain. But what I broke it down on the right is in the green. That's if the president's a lame duck president or if the president is actually running for re-election during year 4 of the presidential cycle. And the numbers are the numbers. The stock market and the economy tend to do extremely well when a president's up for re-election. It's not about Republican, not about Democrat. It's about getting re-elected, and those are just things to be aware of in 2020. It's the lame duck president years that you need to be more worried during year 4 of the presidential cycle. People ask me all the time, what's your favorite chart? It's kind of like picking a favorite kid. Like, I don't know. I'm not sure. It depends on which day it is, right? I've got 3 kids, so some days I do have a favorite. But nonetheless, I thought about it real hard, and I said, this is probably my favorite chart. Pie I've eaten, pie I have not yet eaten. There you go. Another favorite chart. Everyone knows how great last decade was. This might be kind of hard to see, but I'll just talk you through it. It was a great decade for stocks, okay? On an annualized basis, the S&P gained in the 2010s 13.5%. Did you know going back 7 decades, that actually ranks 4th? 50s, 80s, and 90s all had better decades than last decade in terms of what the stock market did. I think a big part of why we had such a good decade last year was how bad the 2000s were. Stocks were negative for an entire decade. 2 50% haircuts, 2 major recessions took place. You gotta go back to the Great Depression again, the 30s, last time we saw something like that. You wanna say why can we have a roaring 2020s? This chart might be the answer. How bad things were in the 2000s. I already said it. Europe is still not even at 21-year highs, or they're just barely breaking out the 21-year highs. It's gone nowhere for 20 years. U.S., yes, we've obviously led, but globally there's a lot of participation, and how bad the 2000s were maybe could suggest why this rally can really continue maybe much longer than a lot of people think. Investing isn't always easy. Don't take the easy way out like these guys. So these guys said that they wanted to get a 6-pack, and they cheated. They did that. You got to earn that 6-pack, I threw that one in. That's a new one. I thought it was kind of, if you guys like it, I'll keep using it. I thought it was funny. Anyway. You got to earn it. Investing is a roller coaster. You have 3 separate 5% corrections a year on average, okay? Most years see a 10% correction. Eventually, you're going to see a 20% correction again. We came so close in 2011 and then in 2018 again. We call those bear markets because they sure felt like it if you guys were around during those times or investing, paying attention. But we've had a great, great run, obviously, for 10 years. But it's a roller coaster. There are going to be pullbacks. You can't take the easy way out and just kind of panic on the way down and buy when things are high. These cycles go for a long time. And speaking of averages, I like to use this one. There is really no such thing as average. There's a statistician, and he put his head in the oven and his feet in a bucket of ice. They said, how do you feel? He said, well, on average, I feel pretty good. Learn from the mistakes of others. You can't live long enough to make them all yourself. Eleanor Roosevelt, I like that one. This is the over-index. This is a proprietary indicator we use. We look at 3 things: overspending, over-leverage, overconfidence. We say bull markets don't die of old age. They die of excesses. We're not seeing anywhere near the spending we saw in the 1980s. You look at confidence, we're not seeing anywhere near the confidence we saw in the 1990s. Look at leverage. We're not seeing anywhere near the leverage we saw in the system that we saw when companies were 40 to 1 leveraged, 10, 12 years ago. They can only be 7 to 1 leveraged now due to new regulation. So again, more reasons to think that this cycle can continue because we're not seeing the overs. Consumer confidence is definitely high, but again, CEO confidence and different confidence measures are not quite as high. Near term right now, though, people are optimistic. We're going to write about this next Monday in our weekly commentary. We think we could be very ripe for a pullback. We've been bullish. We've been very bullish for 4 or 5 months now, and we really do think, though, that we're ripe because everyone's so happy, and that's when pullbacks can happen. But bigger picture, longer term, we're not seeing the overs we've seen before. Just a couple more and we're done. A few things are as surprising as the past. I don't know who quoted that, but I've seen it before. It's a good one. So let's look at the past for a second. We're going to talk about the economy. Can the economy predict the president? If there's a recession, the incumbent party tends to lose. If there's not a recession, the incumbent party tends to win. It's worked every single time since 1924, Calvin Coolidge. Just be aware of that. Now again, a small sample size there, but still, if the economy's doing well, it tends to do well for the party in power. What about the stock market? Can the stock market predict who's going to win in November? We took a look. If the stock market by the S&P 500 is up 3 months before the election, so 3 months, 3 months before and the day of the election, or day before the election, I guess. If the S&P's up, the incumbent tends to win. If the S&P's down, the incumbent tends to lose. And that's it's worked 20 out of 23 times every time since 1980. So what the stock market's doing ahead of the election might give us a little clue. Think back to 2016. Everyone, including LPL Research, said Hillary Clinton would win. She did not. You know who didn't say she'd win? The stock market. We had a record 9-day losing streak from the Dow right ahead of the election. Copper, the industrial metal of copper, a President Trump potential play, had an all-time record 14-day win streak directly ahead of the 2016 election. Markets were saying this isn't as obvious as everybody else thought. So we'll pay more attention to that as we get closer. Just some pretty cool talking points. Another reason you can't always believe what you see, sometimes our brain's a wonderful thing, but it plays tricks on us. So I need a little participation. Stare into this right now. This was a wonderful presentation. Keep staring. I got about 90 seconds. We're gonna wrap it up here. Keep staring. Here you go. Boom. Is it moving? That's Starry Night by Van Gogh. If you looked at that and hopefully it worked, that whole thing is moving. Your brain is playing a trick on you. That picture doesn't move because you saw something first, you remember it, it plays a trick on your brain, and now Starry Night should be moving all over the place. Here, I'm going to end it with 2 things. People always say, what really matters? You just talk for 45 minutes. What really matters? These next 2 things are what I've used in every presentation, literally for 10 years. I've been saying, I'm not seeing warning signs that suggest the economy or the stock market are slowing down. We're going to talk about them right now. Breadth leads price. What is breadth? How many stocks going up versus down? The NYSE Advanced Decline Line is a cumulative number that takes a look at how many stocks go up versus down every single day. This peaks on average 15 months ahead of the S&P 500. The late 90s, it peaked at 98. Stock market kept going up, but the NYSE Advanced Decline Line is going down, meaning not as many stocks were participating. It was a weak underpinning. Tech was only going up. Eventually, the crash happened. In 2006, 2007, Advanced Decline Line started going down well ahead of the ultimate peak in October of 2007. Financials were getting killed. A lot of their stuff under the surface were getting hit. Eventually led to a major stock market correction. The NYSE Advanced Decline Line last week made a new all-time high. You look all around the globe here, not the globe, look here, we like cyclicals, okay? We like technology, which is up 50% last year, so we're coming down a little bit on that. We like financials, we like industrials, we like those cyclicals. Look at kind of the baton being tossed back and forth. Different groups are leading. That's a positive. The Advanced Decline Line is saying there is not likely a stock market peak happening anytime soon. I mentioned the smartest guys in the room are the bond guys. The yield curve said one thing. Look at credit markets. Look at high yield spreads and investment-grade corporate spreads. Keeping it real simple, spreads are very low. Some of the tightest we've seen this cycle. What did we see in 2015? Spreads blew out before a major recession. Before every recession going back to the last 30 years, the high yield market and the investment-grade corporate spreads would blow out. The bond market guys were sniffing something was wrong. The bond market guys are the smartest guys in the room. They're not worried. The Advanced Decline Line, if I can go back. The Advanced Decline Line is making new highs. Market participation's not worried. Those are 2 things that to me suggest the economy will not have a recession and the stock market very well in a year from now will continue to be higher. So many choices. You can look under pies, meat and potato, $1.50. Potato and meat, $1.50. What are you going to do? There's just so many choices. Here's our views. We like value. You talk about value, we think the yield curve can start to steepen, rates go a little higher. We really like financials. Industrials are clearly a play on trade. We think industrials are an area we're overweighting. The defensive names, like your utilities and healthcare, we're kind of neutral on, but energy we don't like as much. But utilities and other defensive names we're not as bullish on because we think this economy is strong. We think this bull market has life, and we're sticking with kind of what got us to the party. We like emerging markets as I laid out there, and when it comes to developed international, specifically Europe, we're having active discussions on maybe dipping our toe in finally after avoiding it for almost 10 years, but we're not quite there yet. So we're going to wrap things up. Why it pays, think outside the box. My doctor told me I needed to start eating more fish, so I started eating like this. He was not nearly amused when I went back. So I went to Xavier. Check out my Xavier socks. And where's Mary's? Put your hand up there. Mary went to Xavier also. She said, "You in Colorado next week?" I said, "Yes." So it's kind of funny how small a world this is. But so Xavier in Cincinnati, that's a picture of my dad. My dad passed away 2 years ago last week. And that was when Xavier beat Villanova, their number one ranked team. I guess it would have been in 2016, February 2016. So enjoy the moment. You just never know what's going to happen. So hopefully this bull market keeps going. Hopefully the economy keeps going. Hopefully cyclicals keep leading. Hopefully emerging markets do well. Those are the things that we're positioning the money that we run for our advisors and for their clients. But without our health, none of this stuff matters. So if I'm ever on LPL Research, I wish you guys all a very healthy and productive 2020. Thank you very much for having me this morning. Got to show this to keep the lawyers happy. There we go. All righty. Thank you.
Cool. So much. I appreciate it. Good. We have some questions. I'm not sure my brain can accommodate everything he just told me. How can one guy know that much stuff? I am interested,
I'll make
though.
it all up.
The direct correlation of the economy with coleslaw, pizza, Corona, and pie. That's my big takeaway, right? And I think the best takeaway for all of us is that all these political ads that we're going to get barraged with over the coming months, they don't mean anything, right? It's all about what the stock market's doing right before the election. So maybe that'd be a great thing for all of us. So thank you both very much. I think it's wonderful to hear their optimism and the positive energy from both of them. So let's thank again both of our speakers. So before we get to the Q&A, we'd like to quickly remind you a feedback survey on our event will be sent to your inbox later this morning. Please take a moment to provide us with your feedback as it helps us make sure that this event stays relevant year after year. So we are going to have a few microphones in the back of the room. So if people want to move to the sides of the room, if you have questions, that would be great. We have a couple questions that have come in already. This first one, Ryan, goes to you. You talked about business investment going down. Again, if you could elaborate on why, and what does that mean for the economy in the next few years?
Yeah, so business investment, plant and property, and just investing in, new printers, new things, versus just simply kind of hoarding the cash. One of the big things that we've heard for a couple of years now is companies are getting money, and what are they doing with it? Simply buying back shares of stock. Okay, now there's some truth to that and some not, but the bottom line is what we really need for this cycle. You look at I didn't talk about productivity. Productivity in the United States is what, like near 40-year lows, I think? I mean, it's low. A big reason we think there is because, again, it's an aging demographic, but business investment really has not been in for 10 years. For this whole 10-year cycle, we think, for animal spirits to really take over and for more positive economic growth. I mean, we barely hit 3% GDP in 2017, and that's the best we've seen since 2006. I mean, the economy is really just kind of meandering along at 2.5%. So business investment again is companies really open up their wallet, building plants and properties, really trying to build new things to help create jobs and help extend the business cycle. And again, the last 2 quarters it was a detractor from GDP. So clearly that's not what we're seeing, and we can only hope, I guess. Hope's not a strategy, I'm fully aware, but we can only hope that with some of the deal with China that just happened, that some of that business investment can definitely come back. And that's kind of that's our base case. We think that's likely going to happen here in at least the second half of 2020.
Great, thank you. Don't forget, if you want to ask a question in person, nobody's brave enough to usually at these things, but we'd be happy to take them. Patty, this next question is for you. You talked about this concern over growth limitations. Boulder has been aggressive in growth limitations over a long period of time, but they had one of the strongest growing economies. Can you talk about that, and what do you see as the impact of these growth limitations, maybe in a little bit more detail?
Well, and again, just to take the step back, again, by the growth limitation, I realized I never really defined it. I mean, but there is going to be a group that is going to be out collecting signatures that for the ballot in November, that they want to limit the number of residential units that can be permitted throughout each county and municipality to 1% per year, okay? Right now, Boulder has a 1% growth limit, and they have seen very limited new development within the city of Boulder. In fact, such that Boulder County has the 7th most expensive housing market in the country. While yes, they have been very successful in attracting those jobs, what has come with that, because the people can't live there, is lots and lots of traffic. And so I think that, you know, the whole growth discussion needs to be happening about, you know, just to limit growth to 1% per year across 11 counties with no regard to the growth plans or the infrastructure of any of those communities. Again, that's a one-size-fits-all type of solution, and not that I believe that that's a solution, but I think that any type of growth limitation, you know, you tend to see those rising housing costs, and we've all gone through that pain, and we're finally starting to see a market where those housing appreciation rates are starting to stabilize on their own. And if you limit that amount of development now, I mean, according to any textbook, any economics textbook I've ever looked at, you limit supply and those prices are gonna go right on up. So that's really not a solution, in my opinion.
Okay, great. I don't see anybody standing at the mic, so I'm gonna pull up a question from our webcast. Brian, this one's for you. You talked about debt levels during your commentary. What are your thoughts on corporate debt and its impact on the markets and the economic cycle?
Yeah, I mean, you know, corporate debt, it gets the same knock, I guess. You know, there's a lot of corporate debt out there if you just look at the number that's there. But, I mean, debt gets a bad rap because what happened, you know, 10, 12 years ago. I mean, there are positives, right? I mean, you know, debt can also, used correctly, can help extend business cycles. And there's been lots of companies that have leveraged debt, you know, a good amount, and it's really helped them. It's when you have to be careful when you're late in the cycle, which again, we don't think so. You know, one thing at LPL Research, I think where we're different than maybe a lot of other investment shops, we think potentially this cycle, and I kind of hinted at it when I first started talking, this cycle is actually closer to the middle than it is the end. So if we're 10 years in, who's to say, you know, we can't have a 20-year cycle? I mean, that's not our base case, but again, we just don't see the signs, the overs that suggest, you know, the cycle's about to end, and with debt, you look at, you know, just corporate profits, right? I mean, corporate profits are expected to hit all-time highs this year. You know, we can get 6-7% earnings growth, like I talked about. So there's positives. I mean, debt's a double-edged sword. I mean, the last thing I'll say, when I got the bug in the stock market at Xavier University in 1999, the stock market going up. My dad gave me some money, and I started using margin. And I remember cutting class, like, why am I going to go to theology? I can go make some money, you know? Like, you watch TV, they say Sycamore Network should buy it, it goes up. I was on margin as much as you could. I had no idea what was going on. Then it goes down, I lost everything. So I learned a valuable lesson that it works, but debt works both ways. You know, hopefully others have learned that before, and people learn it again. History repeats, but we're not as concerned right now with the levels of debt with the corporate side of things either.
Great, thank you. So we have time for one last question, and this again comes from our webcast. One of the big issues in the current political race is the issue of wage inequality in the United States, the rich getting richer, the poor getting poorer, corporate America taking advantage of folks. I asked both of you, what's your take on that, and what impact, if any, do you think that'll have on the economy in the years to come?
Ladies first.
Why, thank you.
Simple question to end with.
Such an easy one.
Wow, let's see. I mean, again, I think that it's important to recognize that wages as a whole are going up. You know, here in Colorado, again, we talked about that we're seeing the second fastest increase in wages in the country right now. Colorado has the 8th highest wage in the country, average wage in the country. So certainly the types of positions that we see increasing and the wages have been going up in general. It's really hard to look at the individual wages. We don't have good data, but certainly when we take a look at income distributions, we have an income distribution that mirrors the national to a large degree, although we do have higher wage, a higher income level at the highest income brackets, I guess is what how I would put it. So we are certainly seeing that income growing at all different levels, but we do know that there are those that are being left behind in our economy. I mean, that's very obvious here in downtown Denver with the homeless population and all. And so as we look at the growth issues, I mean, we need to be really looking at the management of how do we make sure that we can provide affordable housing for all? How do we make sure that we are providing jobs? I mean, from an economic development strategy, we are trying to attract companies that provide a whole array of occupations, a whole array of wage levels that go along with this, so that we are making sure that we are trying to accommodate all education levels, skill levels throughout the area. Always room for improvement, but again, that's certainly is something that we try to do in our strategic efforts here within the community.
Yeah, I mean, the bottom line is there's no easy answer to this one. It is very true. If you have investments in the stock market the last 10 years, you are much more wealthy than someone who does not. And, we think it's a bigger picture why we've had this populist movement, not just in the United States. Look at Greece. Greece had more debt than anybody in 2011, 2012. They were about as left-leaning as any country possibly could be. Greece just nominated a right-leaning government, okay? I mean, these things sway both ways, and we think that's a populist movement we've seen all over Europe in different places, obviously here in the U.S. as well. So that's kind of the byproduct of what's been happening with the wage disparity, and, there's no true easy answer. Like I said, productivity's been low, interest rates have been low. Maybe we get more of a normal period where productivity can start to increase, interest rates can start to go higher a little bit. Those can maybe potentially try to help that, but it is a major problem in our country. Another problem, and I don't have an answer either, with kids going to school, just the debt issue with school. I mean, that keeps going up too. So there's no easy answer there. So those are some of the things that keep us up at night and worry us, is some of the debt issue when you come out of school and you're owing $600 a month until you're 40. That is really, unless you're, those millennials I showed in the first or second slide, you have to worry about. But most millennials really have to worry about some of those things, and there is no easy answer, unfortunately.
Well, thank you both very much. I think a lot of really important things to think about. I think for all of us, this impact on how do we grow our businesses, how do we help grow the economy, but how do we continue to reinvest in our communities just becomes such a critical element, something certainly we're committed to at Vectra Bank. And hopefully today this information is beneficial to you. It's one of our most important events of the year. Hopefully we add value to you. That's our motto here. For those of you who are customers, thank you so much for that. For those of you who are not yet customers, we look forward to changing that soon. Thank you all very much, and best wishes for 2020.